Just because people got burnt in 2017 doesn't mean everything repeats. In the end, Ethereum survived all of that, as did several other projects. And it's a risk curve. We're just starting a whole space. And a risk curve in financial markets, a bond investor might go to corporate credit and then go to junk bonds. Or an equity guy might go to, blue chips to tech stocks to emerging markets. It's normal. It's risk-adjusted returns.
Yeah, and to some degree, those tech stocks were what have, carried everything along, dragged along the rest of the stock market on the way up during this entire correction. And they are arguably as good of inflation hedges as Bitcoin.
And yes, they are. Well, Bitcoin's outperformed them, but still, they're very good. They've outperformed the balance sheet and all of that. So the easiest way to head check, is this a network adoption style story or not? Is just simply do a log chart. So as we do in crypto, right? We're so used to it, but we don't think of it in stock market terms because we're used to mean reverting. But if you just put a chart of Amazon on a log chart or Facebook, they're perfect. They're just perfect network adoption models. They're exactly the same as Bitcoin, exactly the same as Ethereum. They're all the same thing, which is they're just network models. It's brilliant. During lockdown, one of these school teachers or university lecturers, I'm not sure what it was, decided to hold his lectures in one of the metaverses and got the kids to go to attend there. And he found that it was very natural for them to do it. So, and then they were interacting with each other because they could see each other's avatars, and there's Joey there, and there's, Tina over there. They all chat to each other. And I'm like, okay, yeah, everything has changed.
Yeah, which is why, even though NFTs could be argued to be in a bubble as far as price and the art side and some of the use cases, when you really dig into what the future is, I don't see how the NFT space does not continue to grow and absolutely explode. And not because of the art, but because you consider it as the currency of these metaverses that you talk about, because you eliminate the middleman and there's no toll collector in the middle of these direct transactions with NFTs.
It's just an authenticated scarce asset. That's all it is, right? It's like having a painting authenticated by Christie's. Oh yes, that's an original Michelangelo, right? Those words are worth $400 million.
Yeah.
Right. It's an original Banksy. Okay, that's worth 50 million bucks. That's all it is. And then we can transfer it with the trusted ownership. Great. And you know what? It might have some rights with it as well, which is really interesting. We haven't even started where this is all going with NFTs. And, I've also been thinking about the bubble narrative, right? This is a narrative about 2000. Well, look at 2000. That was a terrible bubble. Was it? Yes. If you look at the chart now, it's a blip. Meaningless. It's meaningless. What it was just an S-curve adoption, S-curve phase of the early stage of what we're seeing now, which was Amazon. And that fell 90% then. Now look at it. Should you have sold it? Was it a bubble, or was it just part of the network effects? And I'm starting to see the world differently. And it sounds like crazy, bullish and utopian, but I think we've all been wrong.
Well, I think what people see as bubbles often are just a purge of the things that didn't work.
Now,
right? If you're going to have innovation, you need to have thousands of people throwing darts and taking shots on things that seem absolutely insane. And it's totally fine if only 5 of them succeed.
Of course it is. What are bubbles, and what people misunderstand, is things like commodities. Because commodities, the more they go up in price, the more they create more supply, and the more they lower their own demand, and then they collapse, right? So they're mean reverting. In fact, many things are mean reverting where you're not seeing network effects, i.e. you're not seeing mass adoption. So when there was the short squeeze in Volkswagen back in 2008, it was just a short squeeze. It was a bubble, and then it collapsed. That was not to do with anything to do with the business model or the adoption of it. It was just a technical situation, as was silver. And that happens periodically in various things, and they're mean reverting those kinds of assets. If General Electric didn't change its business model at all, and it went up 300% from here, it's probably likely to mean revert, unless they've changed their business model, which they may well do. But it's just, we need to get our heads around the different types of businesses.
That makes total sense. So I want to go back to something you talked about with obviously the dollar sort of being the denominator for how we view all of these other things. We've always seen an inverse correlation between the dollar to some degree, between
Yeah,
metals.
it's the kind of dollar, but the fiat dollar as opposed to the relative dollar, right?
Right.
Because you're looking at Amazon in dollars versus Amazon in Fed balance sheet. They're two different things. The dollar is a very different beast and nobody really knows what drives it. It has what's known as a Bayesian distribution, which means that there's multi-factor kind of variables that affect it at various times. It could be current account deficits, it could be flows, it could be M&A, it could be interest rate differentials. So it's really hard to forecast currencies. In fact, the best forecasting of currencies is done by technical analysis because nobody knows how to model them. They're really complicated things. So there is times when crypto is correlated and times where it's not. Now, sure, if we have a massive risk off, let's say the dollar DXY goes to 105 in the next month, well, the chances are crypto is going to sell off because everyone's going to freak out.
Last March.
Is that a correlation? No. That's a passing correlation built on risk. There is a risk correlation between all assets because in the end, if you're going to liquidate some stuff, you're going to liquidate some stuff, whatever it is. So, but the overall correlation, that's the great thing, is Bitcoin is not correlated. What they're all correlated to is something called a VAR shock. So that's the value at risk. When volatility climbs in your portfolio, you have to take less risk because if not, your risk of blowing up goes up. So what happens is people reduce risk. We've just seen that with the guy.
Oh my God. Arca something.
Yeah, he had a VAR shock himself, right? So he has to liquidate everything and that created a VAR shock with other people as well. And so people just liquidate anything to pay the bills. And that happens periodically. That is not to do with the fact that the stock market went down. It's think of it as a separate thing. Is if risk blows up, then everything has a wobble for a period of time. And that's okay. And usually what happens is the things that are stronger, that have better stories behind them, better fundamentals, come out of that VAR shock. People don't understand the magnitude of March, right? The entire world stopped. Never happened before. Never. The entire world stopped. As you said, the most liquid markets on earth, the currency markets and the bond markets, basically were untradeable because everybody was at home. There was no risk management. Nobody's in the office. There was nothing. There was no trade going on. Nothing. The world had stopped. So that is the most extreme situation of all time. So if we're trying to correlate Bitcoin to that, this is madness, right? This is.
And honestly, it's almost mind-blowing to think that that was only a year ago when you describe it as one of the biggest global economic events in history, if not the biggest, to see where we are now.
But again, it feels weird to say and see where we are now